Hello, my friends. Today is April 29th. My name is Joseph, and this is Markets Weekly. So this week, we're going to talk about three things. First, we'll go over the major data prints last week, which show an economy that is fine, but a Fed that is losing its battle against inflation. Secondly, we'll talk about the housing market. Now, many people thought the housing market would crash because of higher mortgage rates, but so far it appears that that's not happening. It appears to be stabilizing, and there are signs that maybe a crash won't happen at all. And lastly, I'll give you my outlook for the Fed meeting next week. Okay, let's start with data. Let's start with the Fed's favorite measure of inflation, the PCE index, the core PCE index, which strips out volatile components like food and energy. The Fed thinks that this index is the best measure for the path of inflation. And as you can see, before 2018, the core PCE index was basically bang on at 2%. So the Fed was thinking that it was doing a good job. But since then, since 2022, we've seen that the core PCE appears to be stuck at around 5 to 4%. If you squint, you can see that maybe it's going down a little bit, but this last print, again reaffirms what many are suspecting, and that it seems like core PCE is sticky and it's stuck around 4 to 5%. And even though the Fed has hiked rates aggressively, it's helping a little bit, but it doesn't seem to be making that big of a difference. A big reason for the persistence of a high core PCE is labor. So one of the biggest input costs in the economy is labor costs, which is why the Fed has repeatedly emphasized its efforts to soften the labor market. So our next report that we'll go over shows that they actually haven't been having a lot of headway in that effort. So this next report is the Fed's favorite measure of wage inflation. It's called the Employment Cost Index. Now, every month, we know that we get the non-farm payrolls, which has that average hourly earnings measure. Now, average hourly earnings is not that great of a measure because what it does is it takes all the wages earned, divides it by the people who are working, comes up with an average hourly earnings figure. Now, that measure is very vulnerable to changes in the composition of the workforce. For example, what if during a period of time you have more low-skilled workers entering into the economy? That would scale the average hourly earnings figure lower. Or what if suddenly you have a whole bunch of lawyers, doctors, and tech workers joining the workforce? That would scale the figure higher. The Employment Cost Index adjusts for those compositional impacts, and so it's a much cleaner read on wage growth. And as you can see from these charts here, wage growth is not really slowing. You can see these two charts tell the same story that we saw in PCE inflation. The measures were low pre-pandemic, consistent with 2% inflation, but since then they rocketed higher. Right now it looks like wages are growing at between 4 and 5%, and that's just not consistent with a 2% inflation target. One way to think about this is that inflation can persist because people can continue to afford higher prices. If prices are going up, let's say 4 or 5% a year, but your wages are also going up 4 or 5% a year, well, then you will continue to buy and pay higher prices because you can afford it. Now, the Fed is trying to make this number, this wage number, decelerate by slightly raising unemployment a bit. But so far, again, it's not happening, and it's hard for this to happen because, structurally speaking, we have a shortage of labor in the economy. People in the 1980s had smaller families, and so our workforce population is not growing at the same way that it used to grow. So this is, and of course the boomers, a lot of them retired earlier than expected. So this is something that appears structural and might not change anytime soon, if at all. Now let's go to a more macro measure, the GDP print. The Atlanta Fed Now GDP Now print was showing 2.5% GDP growth over the quarter, which was very good. The expectation is that the underlying potential growth rate of the economy is about 1.8%. But due to last-minute revisions, the GDP now print was revised around 1%, and lo and behold, the official print was around 1%. Now note that this figure will be revised for a few times throughout the quarter. But slower GDP growth suggests a slower economy. An economy growing below trend means that maybe the economy is slowing, maybe the employment market will cool a little bit, maybe wages will cool as well. On its face, it seems like the economy is slowing, but if you look under the hood though, you will come out with a slightly different impression. So Jason Furman, who is a very good economist, on Twitter had a good thread about why he likes to focus on another figure in this report called final sales to private domestic purchasers. So the GDP report measures the amount of goods and services produced in the economy. But that's not necessarily a good measure of the underlying strength of consumer demand, for example. What if you're a car company, and you made 100 cars? Well, if you made 100 cars, you obviously produced goods and services in the economy, and that would have had an impact on GDP. But what if you produced those 100 cars and demand was so weak that they just kind of sat in your inventory? They were not actually purchased by consumers. Then you would walk away with an impression of the economy that was stronger than it actually is. So these inventory numbers can skew the underlying strength of the economy. So changes in inventory impact GDP, and changes in the changes of inventory impact the growth of GDP. When you strip out those inventory impacts, you come away with a picture of an economy that is stronger than the 1.1% would imply. So final sales to private domestic purchases grew at an annual rate of 2.9%. That's suggesting that there is good underlying demand in the economy. So this figure, this GDP print we've gotten is better than it appears on its surface. Okay, the next thing that I want to talk about is the housing market. So as we know, we had a tremendous boom in housing over the past couple years. 2020, 2021, we had house prices increasing, let's say, 20% year over year. And a large part of that was driven by generationally low mortgage rates. Mortgage rates got below 3%. Everyone who could was levering up and buying a house. That all suddenly went away when mortgage rates began to climb. So the Fed began to aggressively hike rates. And in 2022, mortgage rates went as high as 7%. And that really froze the housing market. We've seen so far house prices drop about, say, 10-20% from their peaks in 2022. Mortgage rates so far have remained elevated. They're still around 6 to 7%, but it also appears that the housing market has stabilized. House prices don't really appear to be declining as much as they used to. In many parts of the region, they are stabilizing or even rising. So there's more weakness on the West Coast, but on the East Coast and the Southeast Coast, they're doing fine. And curiously, if you look at the stock of home builders, now this is D.R. Horton, the largest home builder in America, it's pushing all-time highs. So what's happening? I thought that high mortgage rates would kill the housing market, which would be really bad for the home builders. In order to find out more, I listened to their earnings calls, which gave some pretty interesting insight. So their view is that housing market is stabilizing. They're seeing some degree of price increases in select markets. And the way that they're seeing continued demand is that they're offering home buyers lower mortgage rates. So if you went into the market as a home buyer, you're facing 6 to 7% mortgage rates. But the home builders, they're willing to buy down a home buyer's mortgage rate and offer them a mortgage rate of about 5.5%. From their earnings call, they thought 5.5% was the sweet spot that could get the deal done. Now, when a home builder buys down a mortgage rate, it cuts into their profits because they have to spend money to buy the mortgage rate down. So that's cutting into their margins. So we can see the margin graph here. D.R. Horton had tremendous margins of almost 30% in 2022. but since then are around 21%. So 21% is about where they were in 2020. They're describing it as normalizing. They had a period of super demand in 2022, which led house prices to rise and their margins to fatten. But as the housing market cools, they're giving back some of that margin, and that seems to be enough to maintain demand. And structurally speaking, they're not really bearish on the market because they note that resale volumes, resale houses are very low. So inventory is very low. So when you want to buy a house, you can buy it either from a home builder, so you're buying new construction, or you can buy it from someone who, an existing home, buy it in the resale market. Now, anyone who owns a home is sitting on a mortgage rate of about 3% or below. They don't want to sell. If they don't want to sell, then there's no supply in the resale market. The amount of homes available for sale, the inventory of homes, is low. If you want a home, you basically have to go to a home builder, and that gives them market power. Now, demographically speaking, a lot of the millennials are aging into the time where they want to buy a house. So, there's some structural inelastic demand for housing, and at the same time, because the the current homeowners are not selling their home, there's not a lot of supply for housing. So if you have some persistent demand and you have very low supply, obviously the prices will be supported. That means that there's likely to not be any crash in home prices. Back in 2008, there was a crash because a lot of people were underwater in their mortgages. They had, too many houses. They were levering up, buying homes, lost their job, and they couldn't afford the mortgage, and they had to walk away. And so that home ultimately got sold in auction, or let's say in foreclosure. This time around, everyone is locked in to really low mortgage rates. Labor market is fine. Wages are growing at 4 or 5%. There's not really going to be any forced selling. And so that inventory, the resale inventory, is probably going to stay off the market. And so going forward, what's probably going to happen, in my personal view, is that you have home prices move in a sideways way, but over time, wages continue to increase. And so affordability improves, not by home prices going down, but over time, by wages going higher. But yeah, prices will come lower in some markets. This is, real estate is really local, but it doesn't seem like a crash is going to materialize. Now, the last thing I'll talk about is the expectations for the Fed meeting next week. So, basic principle of the Fed is that they don't like to surprise markets. So when the market is pricing in an 8% chance of a hike next week of 25 basis points, that's what they're going to do. And of course, Governor Waller, in his last speech before blackout, also strongly hinted that's the case. So I think that's pretty much a done deal. The real question for the market is not whether or not the Fed will hike, is the trajectory of rate hikes. So I'm not sure if the Fed is done. They could do one more. To me, it's not really that important. I'm pretty sure they will remain open to additional hikes depending on how the data turns out. That's obviously the prudent thing to do. The market continues to price in 2 to 3 rate cuts by the end of the year. That's what I think is very, very unlikely, and Chair Powell will be pretty adamant that he doesn't see rate cuts later in the year. As we've just reviewed, it looks like, one, inflation is pretty persistent, becoming more entrenched. 2, the sectors that are supposedly most sensitive to interest rates, like housing, seems to be stabilizing and potentially reaccelerating. So there's really no reason to be cutting rates when your monetary policy tool is not working the way that it should. The last thing that I'll mention is that, last meeting, the Fed was concerned about financial instability in the banking sector, so it hiked 25 instead of 50 basis points. Now that's all behind us. We have a lot more data to look at what's happening. And I've done a lot of work looking at the earnings calls of a lot of regional banks, and they seem to be pretty okay. Honestly, some of them went out of their way to say that they saw lots of volatility in the market, but in their own business, they didn't see any difference. And when I look at aggregate banking data, just this past week again, banks continue to make loans. So it seems like the overall banking system is fine. There really was no systemic risk there. Now, First Republic, when bank went into receivership, they're going to go under. Again, that's just a neighboring bank to Silicon Valley Bank. We have some localized problems. Now, take a step back, look at the banks that failed: Signature, Silicon Valley Bank, First Republic. Those were banks that were really highly exposed to speculative aspects of tech. When you have over 4,000 businesses, 4,000 banks in the country, just like any other business, some of them are going to fail. I don't really think it's systemic. I don't really think it's a big deal, honestly. And now that we have more clarity, I think the Fed is more comfortable with knowing that, yes, this might have some impact on the availability of credit, but it's not systemic. It's not super serious. I think that makes them a little bit more relaxed when they think about hiking next week and whether or not they'll hike any beyond that. When the market, as I expect, becomes gradually aware that, hey, maybe the Fed is not going to cut rates 2 to 3 times later this year, I suspect there's going to be more downside for equities and strength for the dollar. Rates go higher a bit as well. What I'm seeing in the stock market this week was pretty surprising. It seems like there's tremendous amounts of buying or euphoria or something like that. It's concentrated in a few big tech names, but I suspect that there's a lot of people who are thinking that the Fed is going to cut rates really soon, maybe even do QE, and they're trying to get ahead of that, thinking that that's going to make the stock market go to the moon. I think those people are going to be really disappointed, and at this point, I'm super cautious about the equity market. All right, that's all for this week. I will be back to give you an FOMC debrief, and of course, we'll have our Markets Weekly next week as well. Thanks. Oh, one more thing. I have a new free online course on my website, centralbanking101.com. It's a course on market participants, and it's the first installment of my Markets 101 curriculum. All right, so check it out. It's completely free. All right, thanks so much, guys. Talk to you soon.